Have you heard stories of investors who have achieved unbelievable returns? Investors who could turn a few $1,000s into millions. Some of the early investors of Apple would be billionaires by now if they had never sold. If you bought Bitcoin 10 years ago, you would most certainly be worth tens of millions of dollars. There are also several investors that have made a fortune through a lifetime of wise investments, like Warren Buffett. But behind all these successful stories, there are equally many stories of people who have lost everything. For some of them, this could be avoided if they understood risk and how this can impact your returns. In this video, we will explain risk in a nutshell, and you will learn how to not lose your money. So stay tuned. Welcome to Investing in a Nutshell, the channel where we explain the world of investing so that you can learn and start your own journey as an investor. First of all, what is risk? There are many different definitions for risk. And truth be told, there is not a definition for risk that is accepted by everyone in the financial sector. One way of thinking of financial risk is the chance that an outcome or investment's actual gains will differ from the expected outcome. But that's not really a nutshell definition. Therefore, we will make our own definition of financial risk. We think of financial risk as the probability that you will lose some or all of your original investment. Let's explore this with two examples, one with a very low risk and one with a high risk. The US Treasury bills are considered the safest investment you can make. If you buy and hold on to these, you are guaranteed the interest of that specific bond by the US government. The only scenario that you will not be paid is if the US as a country defaults its financial commitments, which is a fancy sentence for being broke. The risk associated with US Treasury bills is extremely low because your initial investments are guaranteed by the US government. The return you can expect is, however, low. This is often the case. Low risk equals low potential return. Our high risk example is investing into an unknown cryptocurrency in the hopes that you are early and that the coin is just about to explode to the moon. This is an investment with a high risk, since you have a fair chance of losing some or even all of your initial investment. The cryptocurrency can be worthless and impossible to sell at any value. In short, risk is the probability that you will lose some or all of your investment. It's important to understand that there is some risk in every investment, but how much depends on the nature of the asset. Then the question becomes, how can you manage risk? What strategies can be applied to reduce it? One of the first components that can impact risk is time. For some investments, time will reduce risk. For other investments, time will actually increase the risk. Let's say you invest in a global index fund today. What is the probability that you would have lost your money if you sold tomorrow? We would argue close to 50%. But what if you sold in a year or 10 years? In such investments, time is your friend and will reduce the risk as time passes. However, if you invested in a small kiosk on the corner that you like to visit when you need a soda, the risk will increase as time passes. There is a small chance that the kiosk is bankrupt by the end of the month, but in 3 years, it could very well be out of business. The most common way to reduce risk is with diversification. Diversification is holding several different assets. Basically, not putting all your eggs in one basket. Every new asset you introduce to your portfolio will reduce your overall risk. But if you really want to reduce risk systematically, you need to consider the asset's covariance. Covariance is a statistical measure of how two assets move in relation to each other. If you invest in two different hotel companies, they have a high covariance and will be affected at the same time if, for instance, the world experiences a pandemic. Ideally, you should build up a portfolio consisting of companies with a negative covariance to reduce risk. If two companies have negative covariance, they usually move in the opposite direction. A simple example would be two stores. One of them sells lemonades and have their best revenue on sunny days, and the other sells umbrellas and therefore outperform in rainy days. Finally, there are technical ways that can reduce risk for some asset classes, and that is a method called stop loss. Stop loss is a feature offered by most platforms where you trade stocks, bonds, commodities, and crypto. What stop loss is, in simple terms, is a sell order that will trigger if the asset gets below a certain threshold. You could, for instance, immediately create a stop loss when you buy an asset, stating that you should sell if the asset drops to 5% below your purchase price. Using this method, you will in theory never lose any more than 5% on any given investment. It is important to note that this is not always the case in practice. Stop loss only works on assets with some trading volume. The stop loss will not work if there are simply no buyers for your asset, or no buyers for your stated sell price. We have covered 3 methods for reducing risk: time, diversification, and stop loss. Is there anything else you should avoid doing in order to not increase the risk? In fact, there is. In the world of investing, there is a powerful tool that can give you unbelievable returns, but at a very high risk: leveraging. Leveraging is a way to expose yourself to increased volatility in the underlying asset. If you have a leverage of 3 times, you will experience 30% returns if the underlying asset has a 10% return. Similarly, you will experience a 30% loss if the asset has a 10% loss. The mechanism behind leveraging is borrowing money. A $1,000 investment into a leveraged fund, like TQQQ for instance, will give you the same exposure to the NASDAQ 100 index as a $3,000 investment into the index itself. Borrowing money for investing is powerful, but also dangerous if you do not know what you're doing. If you invest your own money, you can only lose whatever you put into the market. But if you borrow from your friends and lose it all, you will be stuck in debt. There are some extreme examples we are going to look into that will show how dangerous leveraging is, even for the major hedge funds. We will cover leveraging in detail in a future video, so make sure to subscribe to the channel and press the like button. It really helps out the channel and enables us to reach more people and help them start their investment journeys. The reasons why many people lose almost all of their money in the stock market is because they don't understand how much an asset must appreciate in value after a solid decline. Let's look at a table that illustrates this. If your asset declines 10%, you only need 11% increase to return to the original value. A 30% drop would require a 43% appreciation. When you pass 50%, it starts to get crazy. If you experience a 70% drop, you need 233% appreciation to get back to the original value. And if you are unfortunate and experience a 90% drop, there is a long way back, needing 900% increase just to bring your investment to neutral territory. Some of you might be thinking, is it really this bad? Few people have lost everything, right? Especially those with knowledge and money will never do that. In April 2021, the financial world was in utter shock. A hedge fund scandal with Bill Wang and his hedge fund, Archegos Capital, became public. The hedge fund lost $20 billion in just 2 days. Bill Wang was maybe the greatest trader you had never heard of, transforming $200 million in 2013 into $30 billion at its peak. To get these results, Bill borrowed more than $100 billion from various banks, and Wang's collapse left a trail of destruction. Credit Suisse alone lost almost $5 billion in Archegos' collapse. The moral of the story: manage your risk and don't ever over-leverage. Another example is long-term capital management, LTCM, which was a large hedge fund led by Nobel Prize-winning economists and renowned Wall Street traders. The firm was wildly successful from 1994 to 1998, attracting more than $1 billion of investor capital, with the promise of an arbitrage strategy that could take advantage of temporary changes in market behavior and theoretically reduce the risk level to zero. But the fund nearly collapsed the global financial system in 1998. This was due to LTCM's highly leveraged trading strategies that failed to pan out. Ultimately, LTCM had to be bailed out by a consortium of Wall Street banks in order to prevent a systemic contagion. If LTCM had gone into default, it would have triggered a global financial crisis due to the massive write-offs its creditors would have had to make. In September 1998, the fund, which continued to sustain losses, was bailed out with the help of the Federal Reserve. Then its creditors took over, and a meltdown of the market was prevented. There are many more examples of both institutional investors and retail investors who have lost everything. This can be avoided by managing your risk. Use techniques like diversification and stop loss, and concentrate on investments where time will reduce and not increase risk. Do not use leveraging unless you really know what you're doing. Even the best investors have been brought down by underestimating the danger of leveraging. We don't say to avoid any risky investment. There are many risky investments that might be very beneficial, but you do need to consider the potential risk and make sure that the potential upside justifies the risk, as well as implementing measures to limit your losses. Risk is just like any enemy, and you know how the saying goes, keep your friends close, keep your enemies closer. We hope you have enjoyed this video, and if you have any question or comment, we love your feedback. We read all your comments. Have a great day, and good luck on your own investment journey.